Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to today's TGI. Thank God it's Friday, the 7th of July. Bull versus Bear webinar. Steve Miley on the call here for Trade Day. Welcome, everyone. Welcome to the lunchtime meeting for me, the morning meeting for you, whatever it might be. Most of you, I guess, are going to be in the US and it's the morning meeting. But if you're in Europe, welcome to the lunchtime webinar. And if you're in Asia, good evening to you. Looking forward to your Friday evening. So we're going to go for our usual regular run through in here today. Take a look at the calendar, what we've had, what we've got coming up. We'll take a look at those macroeconomic, fundamental, geopolitical data and central bank events that are driving markets right here, right now. And we'll take a look at very briefly at the charts. I'm not going to focus very much on the charts, to be quite frank, because after the US employment report, which is obviously the big focus for today, those any levels are going to be probably blown out, and the market's going to go where it's going to go. But I'll have a quick dally into the charts, but it'll be brief. And the first thing I want to do is just to remind you, I put it all over the forums. I've sent an email again, right? I told you before we had a load of traders, 17 traders fell on Wednesday trading through the Fed minutes. I know you guys are all listening to the webinar, know this probably already. The same people come on to the webinars, but just to remind you, today is the US employment report. It is a tier one piece of data. We only have pretty much four events, and they're not even monthly. They're less than four events a month, two data events monthly, two central bank events, which occur approximately every 6 weeks. 8:30 Eastern, 7:30 Central. Okay, you need to be aware. No trading 2 minutes before or after. No orders in the order book either. Okay, you can't be sitting there having orders waiting to trigger as the market breaks. Okay, so you can't be doing that. If you've got those orders, you want to put those orders in. Prep the orders up, but don't put them in, right? Don't actually have them in the order book, because you will fail on that as well. So failing on orders in the order book 2 minutes before or after, or open positions 2 minutes or after, please do exit all trades. After that, do what you want. So we've got that. I just want to give you a heads up on that. I'm not going to go into a big lecture. Right. Let's look at yesterday before we look to today. So despite, almost semi counterintuitively, and this has been the case for some time now, so you have to react this way, right? So normally strong economy equals positive risk on equals stocks go up, right? At the moment, strong economic data equals potentially more hawkish Fed, equals potentially inflationary pressures coming back, equals bond yields go higher, equals stocks go down, potentially a more hawkish Fed. So that's the concern, right? So that's exactly what we saw yesterday. Two bouts of data. ADP employment massively beat. Remember, this is the private, this is the ADP data. Okay. I don't know. Well, I've gone into China, into Chinese for some reason. I assume that's Chinese. It might not be Chinese. Anyway, all right, I'm going to come out of that. I don't know why that's reverted to that. That seems very odd. Let's see if it's on all of them. No, it's only on that one. That's really weird, because it's only on that one. Oh no, it's just on. Oh no, it's back now. Oh, that was really weird. Okay, so the ADP employment report in here. It's a private number. Okay, worked out. It's not the official number. Okay, but nevertheless, 497. We've anticipated at 228. It's a massive beat, right? A massive beat in here, almost double the expectation yesterday. So the jobs market stays very, very strong, very, very tight, and that can put upward pressures obviously on wages and then prices in turn. So that's the reason that's a concern. Then we also had the service sector PMI. Again, this should be a positive piece of data. ISM data, and pretty much most of this ISM data all better than expected, and also the prices number as well. So the prices number is obviously pointing towards potentially inflation. The headline number was significantly beating. Again, if we were confident that inflation was cooling, this wouldn't be a problem, and this would be bullish data for the stock market. Okay. However, because we're not confident that the inflation is cooling, because we're worried about the hawkish tone that still comes from the Fed, this is taken as negative. So we go into risk off, which is kind of counterintuitive. Strong economy equals bad for stocks, right? That shouldn't be the case. It's not normally the case, but in the part of the curve we're at the moment, not when I say the curve, part of the economic curve, and where we are with the Fed, this is being taken as a negative for stocks. Okay, so that's what we had yesterday, and so we have to bear that in mind going into the data today. I know you guys are probably just automatically reacting to the chart and you're not necessarily looking at the data, right? But it could easily be that strong data today reinforces what we had yesterday, and we actually see markets go down on stronger data. So going into today, just to have a look now, bear in mind as well, given that we have so it's the employment report, obviously. Now, one important part is to watch the average hourly earnings as well, because it doesn't matter if the job market's strong, if that's not feeding through into stronger earnings, and stronger earnings feeding through into higher prices. Okay, so that's an important aspect to be watching as well. Okay, so that's the problem with the the non-farm payroll data. It's not just the non-farm payroll data, it's the employment situation. That's what the report's called. It's got the unemployment rate in there. So we could actually see more jobs added, but the unemployment rate go up just by the way it's calculated. That can happen, right? We could have more jobs added to the economy, but the unemployment rate actually goes higher. So that can happen. We could get the non-farm payroll element actually differ to what we, so this could be strong, but we could actually see average hourly earnings go down. So that would be actually a positive. Average earnings was lower than expected. That could be seen as a positive. And it depends how much. The problem with yesterday's data, it was so strong, then that could lead us to think that the Fed are going to be more hawkish. If it's only slightly strong, that's actually probably seen as a positive, because it's probably not enough to cause inflation, but it shows that the economy, that the labor market's still strong, and therefore the consumer's probably still strong, and therefore the economy is still strong. So a little bit of strength is good. Too much strength is probably not so good. Okay, just as we need to do just for due diligence, we do also have the Canadian employment report. If you're trading the Canadian dollar potentially today, and we do have forex traders and trading the FX currency futures, then obviously you've got potential double bubble, double trouble. If the US employment sends the dollar higher, and then the Canadian employment sends the Canadian dollar lower, the dollar versus the Canadian dollar could be very aggressive with its moves. We do get Lagarde and speaking today. I don't see much coming from Lagarde, and also a Bank of England member, man, speaking, probably not anything to impact us. So we're really finishing off today just with that. So the employment report in just under 1 hour, as I said, 8:30. And then 8:30 Eastern, 7:30 Central. Okay, so we're watching that. That's going to be what's going to be key today, clearly. So 5 things you need to start your day in here. So yield surge. So this was the problem. Yield surge yesterday because in the US, this tentative signs of weakness in the US won't be enough to sway the Fed. Okay, so the what we're seeing though is we're not seeing tentative signs of weakness in the labour market. We're seeing strength continuing in the labour market. Okay, yesterday's jobs data set a gauge of global bond yields soaring to the highest in 2008. We can see it here. We were speaking about it yesterday. Something I flagged yesterday, right? Yields spiking higher in here, going to multi-month highs in the US. And it's not just the US, incidentally, right? UK, European yields. So look, we went even higher yesterday. So we'd already broken out. We spoke yesterday about it. Look, even higher yesterday. And look, nudging back to yesterday's highs already today. So this is today in here. Let me just make this a bit bigger. I'll pop this out. Where's the pop out? Oh, there it is. Yeah, so look, we were in here somewhere yesterday. It went even higher, like up through 4%, and as high as like 4.08, and then nudging back towards 4.08 again in here this morning. And we can see that just a dip in. And I showed you these charts yesterday. So this is the 30-year bond going down and hitting the lows in here. Last seen in here, just one sec. Last seen in here back in. So this is the prices, remember. So lower prices equals higher yields. So 30-year bond just holding above these lows in here. And these lows in here were from the beginning of March. And this was from back at the height of the banking crisis, right? So, kind of unrelated, but we're back to when we went to the banking crisis, and also concerns, I think, not only the banking crisis, but we also had it was both the banking crisis and the national debt, the debt ceiling. Okay, the debt ceiling and the banking crisis sent us to these low prices, high yields, and we're getting down close to that on the 30-year. If we look at the 10-year, we're through those low prices over here. Okay, and we obviously saw that on the yield chart as well. That's the 10-year prices, and it's right the way across the curve. 5 years spiked aggressively lower. 2 years as well in here. Look, 2 years spiked lower, did come back, but nevertheless pointing lower in yield. I think, lower in price, higher in yield. 2-year yields I saw, do we have it? I've got it in somewhere. I think it's in one of these, at their highest since 2007, 2008, something like that. Since 2007, 2008, I saw this morning. So Yellen has been in China. She just said some stuff in here which wasn't particularly Yellen criticizes China punitive actions against US companies, urges market reform. So that's not particularly conciliatory in any stretch of in the imagination. So that's not great to see that one there coming through from Yellen. She's in China at the moment. And then more than US China trip in here, more from Yellen as well there. After a hefty fall yesterday following jobs day and the markets moves are more moderate today. Well, yeah, because we haven't really seen the markets move today. Obviously, they're going to be moderate today. Why? Because we've got a massive event coming up. So we're looking for markets to take their cue from the employment report that we get in now for about 50 minutes. Similar outlook here. This is the Take Five, which is the kind of equivalent from Reuters of the 5 things to start your day. And again, in here, talking about markets under pressure because of that strong jobs report in here and concerns about higher inflation from that jobs report in here. So, and then talking about China as well in there. What else do I have for you? Not much really. Stocks drift. Okay, obviously waiting on the employment data in here this morning. And similar in here, investors focus on US jobs report after yields spike yesterday, and slower, still strong US job growth expected in June. So this is looking ahead to the June. Let's just actually go and take a quick look at the data, what we are expecting. So the non-farm payroll expected at 225 is the consensus here from investing.com. Remember though, that has probably been ratcheted up. The expectations are probably for that to be higher given yesterday's ADP number. So probably expecting this definitely, I don't think the market's going to be shocked if this is above 250, 260, 270, right? So it's probably going to have to be above 300 for the market to move again. If it's below 300, the market's probably already repriced that in because of the yesterday's data. What else? Wall Street futures slip ahead of the jobs data. Wall Street traders real as still hot economy fuels. So again, this is what we've been talking about, almost like counterintuitively in here. Strong data, hot economy equals a more negative outlook. And oil is benefiting as well from it at the moment in here, despite concerns about China. But the supply cuts starting to have an effect and coming through in here with the still strong economy. Tentative weakness in US jobs data, we've already spoken about this, won't be enough to sway the Fed. Bloomberg projects 225. What else? Yellen we've already mentioned, criticizing China. And just one other thing in here, UK house prices. So we are seeing slowdowns elsewhere though. UK economies slowing, the housing markets continue to slow. Biggest annual drop since 2011 in the UK. UK housing market does have a significant effect on the UK economy. Right, Asian stocks down this morning. Hang Seng nearly 1%. The Nikkei over 1%. European stock indices kind of flat in here. Mixed. The FTSE is down. We're slightly up on the DAX and the CAC in here. Slight rebounds. And on the overnights in here, kind of flat. Not really much going on the overnights. Fed tool. This continues to slowly either stay higher or creep higher in here, now nudging towards 90% for the next meeting. And if we look into what we're looking for at year end, still pricing in more chance of after we get the 125 up, still pricing in more chance of another rate hike though. Yeah, and this is fading. Remember, this was up at like 10, 20, 30%. The addition that we were going to get a rate cut, basically now zero chance of a rate cut. No one's expecting a rate cut. I don't know why this is slightly even priced in, but nevertheless, it is. And now look, it's even now 50%, only a slight percent of a cut, 50% to be only 25 up, but now 36 plus 6, well, this is 42.5%. So a good chance now, almost as much chance of staying at 25 up as we are going a total of 50 or more up by year end. So we are starting to price in now in the yield curve, in the short end yield curve in here on the futures market, starting to price in 2 rate cuts by the end of the year. What else do I have for you? Just the charts, really. So we've already gone through the yield charts in here. As I said, in oil continued to look strong in here. It had a dip and a rebound yesterday. Didn't quite manage to take out that peak up there that we saw from late June. That is up at 72.72. That's going to be a key level to watch today for potential upside. So even with stocks down now, we've got oil. Oil's been going down with stocks up, and now oil's going up with stocks down. Kind of a bit counterintuitive again on that one there. I'm going to really briefly look at the stocks in here. We did get some negative signals. In the daily report, I've kind of hung on to a bullishness. We kind of had this rebound in here after the initial sell-off. We did wipe out the levels though. So the levels kind of worked yesterday. This is on the NASDAQ. We were talking about this area support. We wiped those out, but have rebounded back to that old kind of support level as resistance. As much as, in my report, remember the report is a bit more aimed at kind of sort of swing traders, bank traders, sort of position traders. It's not so much aimed at day traders in here. So I'm kind of clinging to a bullish view in here. But, this sets up quite negative. But then saying that, you know what, it's all going to be about the data in here today. So, yesterday's lows and these swings high up here needs to clear like 15,300 or down through, 15,110 are like the bigger levels to be watching from my perspective. From the S&P, it's going to be similar in here. Back through the lows, obviously wiped out the supports we spoke about yesterday. Through the lows, down through like 44.19 would be negative. Really needs to clear like the overnight rebound high, 44.51, really though 44.67. So those are my levels: 51 and 67 on the upside, 19 on 2019 on the downside in here. So watching those levels. That's all I got for you guys. Helmets and goggles on for the employment report. Remember, no trading 2 minutes before or after. Going to wish you a great trading day. No doubt will be opportunities today, so I hope those work out for you. Have a great weekend too. We'll be back with you with another bull versus bear webinar on Monday. Bye.